Yo, it is Stocks and Bars, the Stock Market Hip Hop Podcast, the only place you'll find finance mixed with hip hop. And yo, are you looking for a brand new way to learn how to invest? If you are, this podcast is for you. I got my special guest on today, Josh Krafchick of 369 Financial, and he's going to tell you all about how he does it. Let's go. I got my clique ready to use the money they got from jobs, encouraging, teaching them that it's not so hard. I'm doing this, making investing pop. You law is extra. You tuning in to Stocks and Bars. Yo, this is Stocks and Bars, the Stock Market Hip Hop Podcast, the only place you will find finance mixed with hip hop. And yo, today, got a special guest with me, all right? So this is how this one happened, because energy always finds itself. So on Instagram, I'm just doing my normal thing here, and I had a follower send me a message. And he was like, hey, I'd like to jump on a podcast. I'm like, sure, all right, we'll check it out. So went and checked him out. Obviously, you know, we got to do our vetting process, all right? So we went through and checked him out, what he has. How we met is because he saw a reel of mine about hip hop and finance, and he enjoyed that. And then he ended up sending me a reel of his from YouTube that he did a while ago of him doing hip hop and finance as well. So we connected right there just off the hip hop. So fast forward, I went through, I looked him up. Okay, he runs a business called 369 Financial, and he is an investment advisor or financial advisor. Let me get that right. And he helps people in an unconventional way, because unlike other financial advisors that like to charge fees, he does it a little bit differently. We're going to explain that here. In addition to that, he also runs a podcast called Unconventional Money Moves, and we're in the same space. So I'm glad to have my brother on here with me. All right, ladies and gentlemen, let's give our round of applause for my guy, Josh Krafchick. How you doing, man?
Hey, happy to be here. As I tell people, 369 stock so fine.
Yeah, thank you for reaching out. Thank you for thinking of me in order to reach out and do something. I always find it amazing when energy circles back and it ends up completing itself, man. So it's beautiful to have you here. Thank you for being a guest on here. So let's go ahead and get things started here, all right? So tell me a little bit about yourself, how you got here to this point.
Well, I actually went to school for math and never thought I'd be in the financial field. I was supposed to be working for large insurance companies and working as an actuary, which is basically just a person who dictates how much everything costs and determines how to make sure that everything costs what it costs and the insurance company will always be profitable.
Yep.
Based off statistics. It didn't happen. Job market wasn't good. Ended up in the financial field. And within about 2 weeks, I realized these financial advisors don't know anything about investing. I was like, this is a problem. Maybe I could be part of the solution. And that was my introduction to the financial industry. Most financial advisors know just enough to talk a good game. But as one of my favorite philosophers by the name of DMX once said, talk is cheap.
That is how a lot of us start in pretty much anything. We figure we can do something just a little bit better than what we've seen. You know, I got involved in finance for the fact that no one looked like me, one, and two, every area I've lived in has suffered some type of deficiency when it comes to funding, right? And I always figured that should change. And I think the way that it should change is through better education. And I know that hip hop has always been a vessel to me, and I've always listened to it and what the rappers said and all this stuff. So I said, why not tell them something better? And that's why I do what I do. So we're on the same plane when it comes there, man. So you stumbled into to the finance space. You know, you were supposed to be an actuary, and, you know, you ended up doing something a little bit better. So now tell me a little bit about how you ended up starting 369.
It was all an accident. Well, my first job at a large financial institution, I lasted about 3 months there. I remember I was on the phone because a lot of these places you work on a phone in a cubicle farm.
Mm-hmm.
And this older man who didn't know how to use a computer called in. He goes, "Hey, I have these mutual funds from Vanguard. I want to know if you have anything that's similar." And I was like, "Yeah, man, who can't use a computer? I'll help you out because you have these quotes and I got something called Google. So I'm going to use this Google and I'm just going to find something on this website that's similar to what you're asking for." And so I helped him out, provided him the information that anyone with a computer could find. And the next day, I get to my cubicle and my manager's like, "Hey Josh, can you come with me? You got some time?" I was like, "Yeah, I got time." She pulls up the call. We listened to the whole call. She's like, "How do you think you did?" I was like, "Out of 10." And I was like, 10. I did everything he asked for and more. And he was very appreciative of the call. And she stopped me and she was like, "Josh, you realize what you did?" I was like, "Yeah, I helped him out. This guy couldn't use a computer. I was able to find the info and provide it to him." And she goes, "You realize you just gave investment advice to someone and you're not licensed yet. You're not allowed to do that." And I was like, "Whoa." I go, "Whoa, I didn't give any advice. I just provided information." And she's like, "Well, here at this company, we don't give advice to clients." I was like, "What do you mean? We're a really big company. What do you mean we don't give advice to clients?" She goes, "Yeah, like it's just too much of a risk." And it was at that point in time, I was like, "Well, that's a problem."
Yeah.
And I was like, "I'm out." I like quit, got some severance. I went down to Gainesville, Florida to visit for my friend's graduation, got paid for a bunch of time, and I enjoyed my summer and had a lot of fun. And that set me up for my next journey to another large financial institution, or as I like to call them, big faceless organizations. And I was doing real well there. I was making good money, bought my first house at 25. I was getting like 30 grand bonuses every quarter. I thought I was doing good. Then I realized like I'm tapped out. I'm maxed out at like 25. This sucks. Where do I go from here?
Mm.
And the only way I could go was out. So I decided to leave corporate at 27. And that's when my real journey began. And I didn't start 369 Financial till like 3 years after that. There was a bit of a journey to get there from that point.
What was that journey like, man? Because a lot of people, when they leave the workforce or even think about leaving the workforce, it's scary because there's a lot of planning that you are told that you should do to make sure you have all of this capital in place. And not saying that you didn't do any of that, but just kind of describe the journey when you made sure that you were ready to do that. Like, how did you know you were ready to do it?
Well, you look around and you look at the people who've been there for a long time, and you're like, do I want to turn into that? And the answer is like, no. So I took $40,000 that I saved up, bought equity in a independent financial company because I told the guy, "Listen, man, I can't come out making zero. How can we work out a deal where I can get some cash flow to start out so that way I can build my company up, with you as a partner?" Bought equity in a company, paid 40 grand. And I showed up and no one knew I was going to show up. Apparently this guy didn't tell anyone he was bringing on someone new. Then I found out there was like 2 or 3 people before me that all quit before me. And this was all new information to me. The cool part was I worked a couple of tax seasons with a CPA. So I learned all about taxes. I took the enrolled agent tests, passed all those tests. And like, because taxes are important. And most financial professionals know nothing about taxes, not even the basics. I mean, just knowing the difference between 365 days versus 366 days on long-term versus short-term capital gains can be the difference between paying 40% and paying 20% taxes.
Right.
And that was the blessing in disguise. However, the guy wasn't paying me the appropriate amount. He wasn't showing up to work. What we agreed to didn't happen. And ultimately quit there and had to negotiate how in the hell am I going to get my money back? I gave this guy money, like he owes me money. And he was like, "I don't have it." I was like, "What do you mean you don't have it?" What do you mean, man? Your name's on a building. You live in a country club. You drive like a expensive car. Like, what do you mean you don't have it? He's like, I don't have it. So what I could do is I can pay you back over 18 months. Every 3 months, I would get a check. So I use that money to like pay myself while I'm trying to figure out what to do. And then I partnered with an older guy because I'm like 27. I'm not even 30 yet. I'm like, if you get the objection, like, how long you been in business? It's like, well, I've been doing this like 6-7 years now, but I'm partnering with this guy that's been doing it 20 years, 30 years. Like that helps lower the temperature of the room a little bit.
Yeah.
And I told that guy, I was like, hey, last guy wasn't paying me appropriately. You got to pay me if you want me here. And he looked at me, he's like, Josh, I want you to get paid. Well, this guy just didn't pay me at all.
He said, I'll pay you in peanuts.
I mean, he paid me for what I brought on, but like I was doing work, I was posting videos, I was like, coming in every day and like helping with the company, like doing things that weren't my responsibility. And then, so what I did was I left a resignation letter on his desk, and then I flew out to Del Mar in California with my girlfriend at the time, who's now my wife, and right before the whole world shut down, and had a little fun out in California while I figured out what am I going to do next? I got no job. I got nothing coming in, and I didn't know. I don't think anyone knew it was about to go down.
Yeah.
But I did meet with a guy, and he was talking to me about Tesla, and not Elon Musk Tesla. He's talking about Nikola Tesla, like the OG Tesla.
Yeah.
And he goes, yeah, man, like Tesla said 369 are the magic numbers of the universe, and you can figure those out. You can unlock the keys, the secrets of the world. And I was like, 369, damn she fine. I like it. It's kind of ringy.
Gonna suck it to me one more time.
Yeah, I was just like getting the Chris Tucker skit in my like head of him. It was Chris Rock. It wasn't Chris Tucker. It was Chris Rock. Talking about get low, and I was like, 369. Seems pretty catchy. And then I like that 369 stands for growth, family, philanthropy. So you always want to be growing. You want to have strong family values, and it's important not just to take, but to also give back. So as the world is ending as we know it, I submitted a bunch of paperwork to the state of Florida, got my paperwork in, and got rolling.
All right.
That's how 369 was born. Starting literally from nothing.
The American dream, to start your business and keep it going. It's a lot of work to keep your business going. A lot of people.
Yeah, man, I was doing yard work for people. I would Uber. I was doing whatever I could to just like get anything coming in.
Yeah.
Just like I'd be like, hey, I'm gonna go Uber, go make $20. And I was like, all right, I got food for today. I got $20. I can go buy food.
This is the hustle.
Anything's better than zero. But you got to do something. If like no one's calling you to work with you, you got to get money in somehow.
You got to do something, right? And this is the part that is the unsexy part of being a business owner that you won't see on these videos about being a business owner. They'll show you all of the great things. They'll show you the pictures of vacations and cars and whatever it is. But behind the scenes, this is real work. And there's some scary hours that happen behind that work too. So you started 369 and you were off and running. All right. So what are some principles that set you apart from other firms?
Well, I had a lot of free time because no one was calling me. So I went to the library, and I was like, I'm gonna go find a book. And I was walking up and down the library sections. I went past the investment section. I was like, I don't want to read any of these books. I've like read it all. It's like the same crap over and over. A lot of it's wrong. But I found this like ugly yellow book, and it just like popped to me. And like I grabbed it, I looked at it, and I was like, all right, written by Yale professors, life cycle investing. I put it back. I like walked around a little bit more. I just like kept coming back to that book. I was like, you know what? It's free. It's the library.
Yep.
Let me check it out. And I listened to it, and it made a lot of sense. And it was nothing like I've ever read before. I mean, I know a lot about investing and figuring out intrinsic value of companies, and not just investing in exchange traded funds, which a lot of people do, or investing in products, like actually knowing how to value a company and how to determine like, hey, is this a good deal? Is it a bad deal? And when I read that book, it really changed the way I look at investing, which their argument is everyone buys a house with a mortgage because most people don't have the kind of capital to buy a house outright, especially with housing prices nowadays. And they're like, what if you could do the same thing with investments? And I was like, okay, I'm listening. And I really took the strategy to heart. It essentially teaches younger investors to invest more than 100% into the market while they're young, so that way they don't have to invest more when they're old.
Right.
And that's one of the strategies that I do that I'm not sure any other financial professionals doing, because when I met with the Yale professors on our podcast, they said, well, the reason financial advisors don't want to do this because they're scared to get fired.
Everyone's scared of something.
I mean, even if you do the right thing, people are going to fire you.
Yeah. That's also a fact. So can you enlighten us a little bit of what that strategy entails? You don't have to get into too detailed, but what is the general composure of what
the idea is? You have, most people have an income. What you have to do is look at that income as a giant bond. You're also going to get other means for retirement. Let's just say Social Security is still there. That's also another giant bond. So you have this giant bond, and when you're starting out investing, you typically don't have a lot of money. Like You're like, oh, like I have $1,000. Awesome. So what if you could invest $1,500 with your 1,000? So you're actually 150% invested in the market. So let's just say you have a year like 2022 where the stock market goes down. I think it was down like 25, 30% that year. If you're 150% the market, you're going to do 150%, 50% worse than what the market's doing, which could be scary. But in the beginning, the stakes are very low. So you don't have that much to lose. Like you could invest all of your money and lose it all in the beginning, and it's going to be painful, but it's not going to be like a life-threatening illness to your wealth. So while you're starting small, you need to get as much exposure to the market as possible. And the only way to do that is by investing in using margin, which everyone's taught like, hey, that's too risky.
Mm-hmm.
But on the flip side, like, well, you're already using a form of leverage through a mortgage if you're buying a house, but that's mainstream.
So you equate a mortgage and margin as one and the same, because you're using leverage in order to make money. The same concept. Yeah.
If you buy a $300,000 house, get an FHA loan, you're going to put about 10 grand down to buy a $300,000 house. That's 30-to-1 leverage.
Yep. Yeah. I mean, it makes sense. Margin has its its scary sides, only because of being margin called and things like that. I know when you very first ran into it, because I did personally. I did stuff on margin when I very first started as well. And I do remember getting margin called and feeling like my soul was going to leave my body when that happened. And I had to immediately deplete capital from my savings in order to refund my account to make sure that I was able to trade. So is there a situation that you run into before that you had your soul shaken too when you first started using margin?
Well, in 2022, when the market wasn't doing well, I mean, I was just starting out. Like I was only in my second year, and I raised a good amount of money. I mean, not much. I was up to like a few $1 million at that point. But I was looking at $1 million in losses. But I thought to myself, I was like, don't panic. Everyone's down right now. So what can we do so that once the market rebounds, which it will rebound.
Right.
It's not a matter of if, it's a matter of when is it going to rebound? Is this going to be a 1 year thing, 2 year thing? I mean, you start thinking about it, like most bear markets only last about 10 months at the most, 8 months, somewhere in there. They're typically not very long.
Right.
And the thing with 2022 though is it wasn't like COVID where it was like down, up. It was like a slow bleed. Uh, and on top of having $1 million of losses, I lost the three biggest clients I had in terms of
Ooh.
money. Uh,
Yeah, that might happen.
but I held strong. I reinvested capital into well-established companies that I felt were fairly priced. And when everything rebounded, I now have over $2 million in unrealized gains.
Nice.
So
Nice
it worked
comeback.
out. Fast forward 2 years. In the moment, though, I was like,
Holy crap.
just a minus sign and then a 1 and then 0, 0, 0, 0, 0. I was like,
Zeros just kept going.
I was like, man, I was like, do I suck at this? Am I really that bad? I mean, it's hard. It's like these people trust you and you are losing money.
Right. That does take a
But
toll.
I was like, I haven't lost yet. I mean, I'm unrealized. I looked at the positions, I reevaluated. I'm like, what can I sell? And the cool part was I did realize some losses. I bought a position in a defensive company. It's a food company. And I realized $100,000 in losses across the board. And then I reallocated that capital because I took the loss on that and I reallocated the capital into companies that I felt were undervalued during that time. And it ended up working out. And all of the clients were able to write losses off on their taxes. So even though their accounts went up in value on their tax return, they showed no gains.
Yeah, it was a wash, basically.
Yeah, so they realized the losses, they wrote it off on their taxes, but their investments went up and they didn't pay taxes on the gains. They just wrote off the loss. So
Right.
it was a good tax strategy.
So to the tax point, all right, and well, not to the tax point, to just managing finances in general, right? We talked about how you were managing it and it was scary. You know, you had to question yourself about, are you really built for this? Because dude, just hearing that, that made my heart sink. And I didn't lose the money. I'm very frugal as it is. Well, technically, yeah, because it's not realized until you sell it or give it back, one or the other. So how do you balance taking those type of risks and keeping things stable with your clients?
Well, that's the tricky part. I mean, I have had clients leave because they get scared of the fluctuations of the market. And what I realized is people aren't built for the psychological warfare when it comes to investing, especially when their accounts start to get to the highest point they've ever been in their lifetime. So it's like right now, if you are invested, right now is probably the most amount of money you've ever had. And you're like, well, how much higher can the stock market go? And once you start getting up to, hundreds of thousands of dollars, let's just say you have $500,000 invested, 1% move down, that's $5,000. You look at your account, you're like, oh crap, I'm down $5,000 today. If you're not used to that because you haven't grown with your money, you still have like a poor mindset. You're looking at it as like, I lost $5,000 today. Versus when you starting, if you have that $1,000 invested and you lose 1%, you don't even look at it. You're just like, oh, whatever. I'm down what, $10?
That's it. Yeah, I don't.
So people freak out and they get defensive. However, once you get into the six figures, Charlie Munger said, the first $100,000 is the hardest to save up. Once you get to 100,000, now your money is really starting to compound. And that's where you really have to not get too defensive. And you have to make sure that you keep the pedal to the metal. So that way your 100,000 turns to 200, 400, 800, 1.6 million, which, if you invest it wisely is definitely achievable over time. So yeah, I mean, I've lost clients because I feel like I made the right investment decision. It's just they become impatient or they just don't believe in me. However, most people did stay with me and they're very happy.
Good. Now, what type of strategy did you use or adjusted in order to help you reverse those losses? Because I mean, that's a big swing. I mean, if you're able to dig out of the hole of, $1 million per se and end up back in the green, back to the side of 1 million and another one on top of that, that is awesome. So You mentioned that you did some research in order to find companies that you felt were undervalued. So like what type of strategy are you using in order to help identify those type of companies?
It's a system. So, I mean, I went to, you ever hear of InvestFest
Yes.
in
Yes, I have.
Atlanta? Were you there?
Yes. No, I haven't been to InvestFest. No.
I went and I checked it out, and everyone's teaching like, oh, this is how you like read charts. Oh, this is how you trade. And I'm just like, that's that's not how you do it. You have to have a system. So I mean, step one is for me, I came up with something called like the 10 commandments of investing. And I
Okay.
took like my top 10, and I could share it with you and you could share it with anyone. I don't care. Um, I took everything that I've learned from all the books, all the letters I've read. Like I've read all the Berkshire letters. I've read Common Stocks, Uncommon Profits by Philip Fisher. I've read the Life Cycle Investing. I mean, I've pretty much read all the big ones. Intelligent Investor.
Mm-hmm.
And I was like, what is my system? So step one is what I like to do is I run and you can Google it. It's called a Graham calculator.
Okay.
So I take the share price. What is their earnings per share over the last trailing 12 months? And then you put in a growth rate. I typically start with a 1% growth rate. So I'm like, all right, if this company grows at 1%, is it overvalued, fairly valued, or undervalued? Overvalued, fairly valued, undervalued. And I start there. And I was like, all right, if it's undervalued, now I dig deeper. I'm like, all right, what's the price to earnings ratio? Where is it trading from its 52-week high to its 52-week low? If it's near the low, I've learned it can always go lower. So I've put in a rule where I like to wait to see a company recover by at least 10% before I'll jump in if it's at 52-week lows.
Nice.
That tells me like if you have $1 billion company, and it goes up 10%, $100 million have gone back into that company. So that tells me something like, hey, $100 million just went into this company for it to raise by 10% in market value. So I'm like, all right, I'll give up that 10% for peace of mind of like, hey, this looks like people are starting to trickle money back into this position.
Yeah.
In addition to that, I don't care about the share price. Something I've seen a lot of people do is like, I'll tell them about a company and I'll tell them the share price. And I can't share like the investments that we have just because that's like one of the things I don't tell.
Right.
But one of the positions that we have in our portfolio has like a $9,000 share price. And they're like, well, why did you buy that? It's so expensive. It's like, well, if you go through the system and you look at their earnings and based on where they're trading, I mean, I bought it at like $4,000 a share. And people thought it was expensive. Now it's doubled up. Now it's more expensive. And the cool part that I've learned is the higher the share price, typically the less the trading volume is.
Mm-hmm.
Meaning there's less people doing options trading. There's less institutional investors manipulating the share price. And that's one of the reasons Warren Buffett has never really done a stock split ever. It's because he wants to control the supply of how many shares are in the marketplace. So I like companies that have higher share prices because it makes it easier to do these computations versus when a company like NVIDIA splits, they basically just increase the amount of supply in the marketplace. And that's why a lot of people like Bitcoin is because of the finite supply. And that takes a lot of the funny business out of it as well.
Yeah, I never really thought about it on the Bitcoin side of things. I always think of Bitcoin. This is off tangent. I'll get back on. But anyway, I always think about Bitcoin as if it's going to be what people think of it as, a source for people to use, for the regular common person to have access to, right? Eventually, the idea is that you can be able to go to the store and use Bitcoin to buy something. But I always thought, well, to access it right now is just too difficult for the common person to get to. There's a lot of different steps for you to access it. And I think when that gets simplified, then it becomes easier for the average person to get to. But that's my personal opinion on it. Back to what we were talking about. So here we are now. All right. You've gotten your way in your financial advising and helping people. And you also have a background on taxes, which you just talked about earlier in the podcast. Is there a specific tax strategy that you see people don't take advantage of enough?
Well, one of the commandments is don't be scared to sell at a loss. People are like, you'll see on the message boards, which I go on for to see exactly what not to do. Whether you're going on like a Facebook group or Reddit, people's like, you don't lose unless you sell. You don't lose unless you sell. It's like, well, one of the items inside of one of the Berkshire letters that Warren Buffett wrote is, well, if we invest our money conservatively, and this is hit the news, is like, oh, they have like $300 billion in cash. So they invest conservatively because they don't know how to put the capital. Like they see no good choices. They put it into conservative investments. And let's just say markets go down. They would rather sell conservative investments at a loss and then reallocate that capital elsewhere. And it gives them the tax benefit. They take the loss in the tax year. They get to buy a company that they want at a better price because you enter in a bear market. Bear markets are normal. Market corrections are normal. Pullbacks are a good thing.
Yes. And
you have to get excited because if you see the new Nikes on Black Friday go from $500 or however much they are to $199, you get excited.
Right.
However, with investing, everyone freaks out.
That is it for this week's episode. Make sure you come back next week for part 2 of this. Tell me what you learned about this new strategy, and if you've used it before, hit me in the comments. I got my clique ready to use the money they got from jobs, encouraging, teaching them that it's not so hard. I'm doing this, making investing pop. You law, it's extra. You tuning in to Stocks and Bars. Stocks and Bars. Stocks and Bars. Stocks and Bars.